this chapter is on risk and then calculating rates of return. So the first, we're going to have two different types of problems in here. So the first one deals with our expected returns. So our expected returns are going to be based on probability. Okay, so then they're going to give you the stock or the investment, and then the chances that we would get this return. So with this scenario, we have stock X, and then there is a 10% probability that we're going to lose 10%. There is a 20% probability that we are going to make 2%. Then there is a 40% probability that we're going to make 12%. Then we go back down the other way. Then there's a 20% probability that we are going to make 20%, and then there is a 30% probability. A 10% probability that we're going to make 38%. So then, if you'd add up these probabilities, you would see you're at 100%. And then these are going from worst case scenario to best case scenario. So how we solve that mathematically, again, it's going to be based on the probabilities. We take each line and kind of put it into a mathematical computation. And so what I do is I make the 1 a decimal. So I'm going to say, okay, there's a 0.1 chance that I'm going to lose 10%. Then there's a 0.2 chance that I'm going to make 2%. There's a 0.4 chance that I'm going to make 12%. And then there's a 0.2 chance that I'm going to make 20%. And then there's a 0.1 chance that I'm going to make 30%. So hopefully that all fits on there. Okay. So then, again, I have each line item in that table as a separate mathematical computation. And then we just do them individually and then add them together. So then just make sure you pay attention to your negatives, though. So then now if you say, okay, a 0.1 times 10, that gives me a negative 1%. Then a 0.2 times 2, that gives me a 0.4%. Then if you take 0.4 times 12, that gives me a 4.8%. 0.2 times 20 gives me 4%. And then 0.1 times 30 gives me 3%. So again, I just did the math kind of as you see it and then carry the percents down. Then you can just sum those up or add those together. But just remember this first one's a negative. So a negative 1 plus 0.4 plus 4.8 plus 4 plus 3 gives us 11.2. So then we would have an expected rate of return of 11.2%. And then what we do is we compare that to our required rate of return, which is our next computation, except for it'll be a different problem. But then you would say, okay, if my expected rate of return is 11.2, as long as that is greater than my required rate of return for this investment, I would be willing to do it. So you're going to make that comparison with that rate. Then the textbook gets into a lot of different statistical ways to determine the risk. So you will have to do that for your homework. For your homework, you're going to have to calculate a standard deviation and a coefficient of variation. How I'm going to do it here and how it would be done on the test is just calculating the range. So your range is your high point minus your low point. So with this example, we have a high return of 38%, and then we have a low return of a negative 10%. So remember your math rules. A double negative makes a positive. So that's really going to be a 48% range. And then our rules would be the higher the range, the higher the risk. Okay, so then that is going to be how you calculate those expected returns based on probability. And again, we factor in risk just by using this range computation. Then the other type of return that we're going to calculate is our required rate of return. So then with our required rate of return, we are factoring in risk to say at what point, what do we need to make in order to make it worth taking on that risk. So that's a whole different formula. So let me erase this. And what we will use is what the textbook calls this CAP-M formula. So this is our required rate of return. And again, it's the required rate to compensate us for risk. And it's using the CAP-M formula. So the formula is our risk-free rate plus the beta times the market rate minus the risk-free rate. So that's our formula. So then just to kind of explain these different things, the risk-free rate is based on the government treasury bond, or the T-bill is what some of the problems will call it. But that's basically saying from a financial standpoint, if I'm investing money in the markets, that's going to be the most risk-free investment I can make is a government T-bill or a government bond. So that's what our risk-free rate will be. The beta is a measure of the individual company's risk. So the textbook goes back and gives you a table, but the higher the beta, the higher the risk. So I could write that over here because you do want to know that. So the higher the beta, the higher the risk. So again, it depends on the market at the time, but the textbook I think has like Bank of America as one of the ones having the highest risk. And then it has like a bigger company, Procter & Gamble, is the lowest risk in this particular table. So again, your higher risk companies are going to have that higher beta because that beta is an indicator of risk. A lower risk company is going to have a lower beta. And then basically what that beta is saying is that how it does it move with market. So if market goes up, a firm with or a company with a high beta is going to go up even above market. But if market goes down, it's going to go down below market. So it could be very erratic. Do you mean it could be up, could be down, could, as you're opening those statements, you could be losing money and then making money. So it's all over the place. A company with a lower beta, so like they give us the example of Procter & Gamble, it's going to move less than market. So market may go up, it'll go up but not as much. And then market may go down and it'll go down but not as much. So again, your swings are much lower. So that's a more conservative company. So that's what our beta measures. Then the market rate is whatever the market rate is for the investment we're in. So we're mostly in this one talking about stocks, but it could be the bond market or the stock market, and it'll just give you the average rate of that market. And then that's what we use there. So then we have a problem where we have this manufacturing company has a beta of 1.5, so that's going to go here. So again, it's a little bit riskier. And the required rate of return of the market, the entire stock market, is 12%, so that's our market rate. And then it tells us that our bonds, the risk-free investment on the bonds is 5%. So that's going to go into both of these spots. And then just a reminder, because this is honestly where students will make their mistake, is they don't get rid of these parentheses. Remember, go back to your regular algebra rules. We want to get rid of the stuff that's in the parentheses first. So if we take our 12% and subtract out 5, that leaves us a 7%. And then the book calls that a risk premium. So that's the risk associated with investing in the stock market over a government bond. So we again, because it's more risky, we expect to make that higher return. But then now we have to multiply that by our 1.5, because then the 1.5 is saying that this manufacturing company is actually more risky than market. It's 1.45 times as risky. So we take 1.45 times 7, and that gives us 10.15%. And then we add that back to our risk-free rate. So then our required rate of return on this investment would be 15.15%. So again, if you kind of try to get the big picture, so you got to be able to calculate the formula, but you kind of want to understand what you're computing, look back to your market rate. So an average stock I would earn 12%. But an average stock would have a beta of 1. It would be exactly equal to any other stock in the market. Because this one is greater than 1, higher beta means higher risk. It means I want to get compensated for that higher risk. So my required rate of return on this investment is going to be 15.15%. I want to make more because it's a little bit more risky of an investment. You could have it go the other way. If it was, if the beta were lower, so say if we had the same scenario, and then the beta, let's say, is 0.85, then you'll see that it goes the opposite direction. So I still have that 7% change here, but then now I'm going to multiply that by 0.85 because it's going to be a less risky company. So 7 times 0.85 gives me 5.95%. Add that back to my risk-free rate of 5. And then this particular investment, I would be willing to take it if I would at least earn 10.95%. So again, the average market is 12. I'm willing to take less than average market because this is a more conservative investment. There's less at risk. So then you want to be able to calculate this formula, again, whether it's a high beta or a low beta, and be able to come up with what that required rate of return is. So both of these computations that we did calculated returns, and they factored in the risk.